Most investors don't lose money because they are stupid. They lose money because they are humans. They read the same books, they hear the same advice, they have access to the same markets, yet year after year, the majority underperform, panic, or quit entirely. And here's the most disturbing part. Most people lose money even in markets that go up. So the problem isn't the stock market. It isn't crypto. It isn't the economy. The problem is behavior. Today, we're going to expose why most investors lose money, the hidden traps almost everyone falls into, and the exact principles long-term winners follow to avoid them. If you understand this video, you'll already be ahead of most investors on the planet. Stay until the end, because the final mistake is the one that quietly destroys fortunes without anyone noticing. 1. The shocking statistic no one likes to talk about. Let's start with facts, not opinions. Multiple long-term studies show that the average investor consistently underperforms the market, often by several percentage points per year. This gap is known as the behavior gap. It's not caused by bad assets, it's caused by bad decisions made at the wrong time. Ironically, the very actions investors take to protect themselves are often what destroy their returns. Understanding this gap is the first step to avoiding it. 2. Why investing looks easy but isn't. On the surface, investing seems simple. Buy assets, let them grow, get rich over time. But if it were that easy, everyone would be wealthy. The truth is, investing is not hard intellectually, it is hard emotionally. Markets constantly test your patience, confidence, and discipline. They go up slowly and fall quickly, and the human brain reacts far more strongly to losses than gains. This is known as loss aversion. The pain of losing $1 feels about twice as powerful as the pleasure of gaining $1. This single psychological trait explains a huge percentage of investor failure. Mistake number 1, buying when everyone is excited. Most investors believe they buy low and sell high. In reality, they do the opposite. They buy when headlines are positive, friends are talking about it, and prices have already gone up. This is called performance chasing. By the time an asset becomes popular, much of its future growth has already been priced in. History shows this pattern again and again. Tech bubbles, housing bubbles, crypto hype cycles, and meme stocks. People don't buy because something is cheap. They buy because they are afraid of missing out, and fear is never a good investment strategy. Mistake number 2, selling when fear peaks. Just as excitement causes bad buying, fear causes catastrophic selling. Markets don't fall gently, they fall violently. Red days turn into red weeks turn into panic. This is when most investors sell, not because their plan changed, but because their emotions took control. The tragic irony, the worst time to sell is often very close to the best time to buy. History shows that missing just a few of the market's best days can destroy long-term returns. Yet fear convinces people that this time is different. It almost never is. Mistake number 3, confusing activity with progress. Many investors believe being active means being smart. They trade frequently, adjust portfolios constantly, react to every piece of news. But study after study shows the more people trade, the worse they perform. Why? Because frequent trading increases costs, increases taxes, and amplifies emotional mistakes. Long-term investing rewards patience. Overtrading punishes it. The most successful investors often look inactive because inactivity protects compounding. Mistake number 4, overconfidence. After a few wins, many investors start believing they have special insight, they can time markets, they can beat professionals. This is known as overconfidence bias. Markets are brutally efficient. Millions of intelligent people compete simultaneously. Believing you can consistently outsmart them is not confidence, it's arrogance. The market humbles everyone eventually. Those who survive are those who respect it. Mistake number 5, lack of a clear strategy. Many investors don't actually have a plan. They have opinions, hunches, emotions. A strategy answers questions before chaos arrives. What will I buy? When will I buy it? How long will I hold? When will I sell? Without a strategy, every market movement feels personal. With a strategy, volatility becomes background noise. Why saving mindsets ruin investors. One of the biggest problems investors bring into markets is a savings mindset. Savers fear volatility. Investors expect it. Markets move. That's not a flaw. It's the price of growth. Trying to invest while demanding certainty is like wanting rain without clouds. The wealthy understand volatility is the entry fee, compounding is the reward. The role of time, why most people quit too early. Most investors don't lose money permanently, they lose patience. They quit during flat periods, bear markets, or temporary declines. But long-term data shows time smooths volatility, patience captures growth. Markets reward those who stay invested far more than those who try to be clever. How the wealthy avoid losing money. The wealthy don't have secret information, they have superior behavior. They invest consistently, diversify broadly, rebalance calmly, ignore noise, and think in decades. They don't aim to win every year, they aim to avoid catastrophic mistakes. Avoiding big losses matters more than chasing big wins. The simple framework that works. Winning investors follow a boring formula. 1. Earn income. 2. Convert income into assets. 3. Diversify investments. 4. Stay invested. 5. Reinvest returns. No hype, no shortcuts, no drama. This simplicity is why it works. The final hidden reason most investors fail. The biggest reason most investors lose money is that they expect investing to be exciting. It's not. It's repetitive, predictable, emotionally uncomfortable, and that's exactly why it works. Wealth is built quietly, while others chase excitement. Closing. Most investors don't fail because they chose the wrong assets. They fail because they chose the wrong behavior. Markets reward patience. They punish emotion. If you can control yourself, you don't need to outsmart anyone else. Subscribe to the Wealth Code for clarity, not noise. Because money doesn't reward intelligence alone. It rewards discipline. You, rich.